Okay, let's dive right into this explainer. Today, we're drawing a hard line between what you think you're interacting with and reality itself. Whether you're a total novice or a seasoned veteran, there's an invisible barrier sitting between you and every decision you make in a complex environment, and we are going to expose it. Here's the fundamental truth we really have to unpack today. You are not trading the market. In fact, nobody has ever traded the actual market. Think about a trader sweating over a sudden trend reversal, frantically clicking buttons to close positions. They aren't reacting to the raw, unadulterated market. They're interacting with a mental representation of it built from their own past experiences, personal biases, and historic wins and losses. That model, and only that model, is what dictates every single move.
There's just a massive gap between reality and perception. On one side, we have the market. It simply moves. It expresses absolute reality in real time. And spoiler alert, it absolutely does not care about your model. It doesn't reward your accuracy or punish your inaccuracy, it just exists. On the other side, we have the model, which is full of your predictions, biases, and beliefs. So, the crucial point is this: the gap between what the market actually does and what you expected it to do is never a market problem. It is entirely a model problem. And model problems are literally the only ones you can actually solve.
Section 1. Map versus territory. The grand illusion. To truly grasp why we fall into this trap, we need to look at a foundational concept from cognitive science, introduced in 1931 by philosopher Alfred Korzybski. He stated simply, the map is not the territory. A mental framework, or a map, is a highly useful simplification of reality. It allows you to navigate an environment that's way too complex to fully comprehend in real time. But Korzybski warned that the territory always holds vastly more detail than any map can possibly represent. A map is completely necessary for navigation, sure, but the traveler who confuses the map with the actual terrain is eventually going to walk right off a cliff that simply wasn't printed on the page.
Let's bring this down to earth and look at your daily practice. When you sit down at your terminal, your map consists of highly precise mental constructs. It's the support and resistance levels you've identified, the macroeconomic trends you assume are happening, the technical setups you trust from past success, and the narratives you've constructed about why a price should move a certain way. These tools are incredibly useful for making decisions. Without them, you'd have no basis to act. But you must remember, they are just ink on a map. They are not the actual territory. The very second you treat your model's prediction as a concrete fact, rather than a probability assessment in a highly complex system, you stop trading. You start uselessly arguing with a market that literally isn't listening. We've all seen it or felt it, right? Staring at a screen, furious that a stock isn't behaving the way it should. But the market has no interest in your argument. It's just going to keep moving in whatever direction the territory actually points, completely regardless of what your map said.
Section 2. The Stoic Perception. Examining the impression. Now, what's really fascinating here is how ancient philosophers perfectly diagnosed this exact cognitive trap thousands of years ago. The Stoics built their entire philosophy on a distinction that most of us blur every single day: the difference between an impression of a thing and the thing itself. The Stoic philosopher Epictetus called this primary discipline phantasia kataleptike, the comprehensive impression. It's an accurate perception of reality entirely stripped of your personal projections, your hopes, and your narratives. Epictetus taught that most of our errors don't come from reality itself, but from failing to separate reality from our completely unexamined impression of it.
Think about it. An unexamined model trades on blind assumptions and totally ignores conflicting reality. When the market turns, the unexamined model just freezes, hoping reality will bend back to fit the map. But the examined model? It knows its own assumptions, its required conditions, and exactly what specific evidence would prove it wrong. Just as Marcus Aurelius practiced the daily discipline of strictly checking reality against his internal impressions before acting, a successful decision-maker continuously examines their model against the raw, unfiltered data of the environment. Examining your model doesn't magically give you a crystal ball. The future remains inherently uncertain. But what it does guarantee is a higher accuracy of your perception. And in a probabilistic environment where everything is a calculated risk, accuracy is worth infinitely more than certainty. Accuracy is what actually keeps you alive when the unexpected happens.
Section 3. The Dynamic Model. Updating your coordinates.
So the crucial point is that a static model built for last year's market conditions is going to become actively misleading when the environment changes today. To survive inevitable market shifts, you need to implement this specific three-step architecture for maintaining a dynamic model: the model inventory, the regime awareness check, and the model update protocol. Let's break these down to build a model that actually breathes with the environment.
First up, step 1, model inventory. You've got to drag your foundational beliefs right into the light. Not just your overarching strategy, but the deep assumptions beneath it. Do you believe volume confirms direction? Write it down. Do you believe large caps offer safe havens? Write it down. Then, ask the most uncomfortable question possible. What specific market behavior would prove this assumption wrong today? You have to define your invalidation criteria before the market hits you with it. Otherwise, you'll just rationalize the loss away.
Second, step 2, the regime awareness check. You need to perform a weekly check to ensure the map you're using actually matches the structural character of the current territory. Think about characteristics like movement, volatility, liquidity, and what's driving the market. If your original model was built for a highly volatile, trending environment with deep liquidity, but the current reality has shifted to low volatility, news-driven chop, well, your model becomes actively harmful. You haven't necessarily lost your edge, the territory just changed, and you forgot to update your map.
And this brilliantly illustrates the final step. Step 3, the model update protocol. When your predictions consistently diverge from reality, do not force the market to fit the model. That is a game you will always lose. Human nature wants to defend the ego, to hold on to the original thesis, because admitting defeat is painful. But you've got to have the non-defensive willingness to redraw the map based on rigid evidence. Redraw it based on what is actually in front of you, not what you desperately wish was in front of you.
Section 4. The final challenge. Reality always wins.
Let's build this into an actionable practice you can execute right now. So I have a question for you, and I want you to answer it honestly. When was the last time you actively examined the assumptions underneath your trading model? If your answer is never, you are navigating extremely dangerous terrain using a map that has never been compared to the landscape it claims to describe. You're operating on pure faith in a space that demands pure calculation.
I really encourage you to start this comparison today. Here is your daily practice to fix that. Start by writing down just one core assumption. Ask yourself what specific evidence would prove it wrong, and then actively hunt for that evidence in today's market. Do this weekly across every single assumption you hold. This is literally the only way to guarantee you remain a navigator who actually adapts to the terrain rather than a stubborn traveler walking blindly off an unmapped cliff. Because ultimately, there is one truth you can never escape. You can choose to rigorously examine and update your map, or you can blindly insist that your model is right and the market is wrong. But ask yourself this: when has a piece of paper ever won a fight against the actual terrain? The territory always wins. So what are you going to update on your map today?